If you would like to know what provisions are, this video will give you a foundation so that you can better understand this important type of liability. We saw in the video on provisions, what they are not, that many people have the incorrect view that provisions in a firm's accounts are backed by cash and represent a pot of money set aside to meet future obligations for a firm. For example, employee entitlements such as provision for annual leave or long service leave. This is simply not true. There is an accounting standard on provisions which it shares with contingent liabilities and contingent assets. This accounting standard makes it clear that provisions are liabilities because they win the trifecta. They pass the 3 time-based aspects test. There is a past event, a present obligation, and a probable future outflow. The use of the word probable here means that the outflow of resources embodying economic benefits to settle that obligation is more likely than not to occur. That is, the probability that the outflow of resources will occur is greater than the probability that it will not. The use of the word probably can mean different things in different accounting standards, but this is what probable means in relation to provisions. It simply means more likely than not. It also needs to be possible to make a reliable estimate of the amount of the obligation that the firm has to meet. But what makes a provision different to other liabilities is that it is a liability of uncertain timing or amount. This requires us to estimate and use our judgment when measuring provisions. A key word to think about with provisions is the word uncertain. This uncertainty is not about whether or not there has been a past event, resulting in a present obligation, the future settlement of which it is probable will result in a future outflow of resources. These are each clear with provisions, as with all liabilities. The aspect that is uncertain with provisions is the timing or amount of the future outflow of economic benefits. With provisions, this needs to be estimated. We can think of provisions as provisional in terms of their timing or amount. The liability exists, but we will have to wait and see to what extent the estimates and judgments we make today prove to be correct. When you study Act 19061 Advanced Financial Accounting, you will need to have a strong understanding of what provisions are and how they differ to other items in the financial statements, such as reserves. Watch this space. For further information on provisions, go back to Chapter 6, Section 6.3 in the study guide, and also review the Liabilities Weekly questions. Also answer, write and rate questions on liabilities in Peerwise.